Included in our agenda, I'm going to be covering the performance of the major market indices and asset classes so far this year through the end of April. We're also going to be talking about the market rally, now referred to as the Trump bump, and the Trump economic agenda we refer to as Trumponomics. We're going to be introducing our Legacy Wealth Partners Macroeconomic dashboard, and we're also going to be talking about opportunities and risks that we see in the financial markets today. Here's the performance of all the major financial market indices so far this year. As you can see, strongest performance has come in the United States from the NASDAQ index and globally from emerging market stocks. As we know, the stock market went into full-on rally mode right after the election. In fact, U.S. stocks gained 5.8% in the period of time from the election until the inauguration. This was, in fact, not the largest gain in history, but only the fifth largest. But stocks have performed incredibly well. Here in the U.S., the index have gained very strongly from the election until the end of April, as you can see here indicated on the bottom, with the NASDAQ performance representing the largest gain so far on the backs of strong returns from technology stocks in particular. The strong rally we've experienced in the stock market has come about largely as a result of increased optimism over the economic agenda proposed by new President Trump, that we now refer to as Trumponomics. It includes the simplification of the tax code, lower tax rates proposed for corporations, lower rates for repatriated earnings of U.S. companies now held overseas, increased investments in infrastructure and also the military, as well as reduced or rolled back regulations, and probably the most hotly debated component of the Trump agenda involves an increased focus on creating American jobs in manufacturing, but also at the expense of making foreign imported goods more expensive for U.S. consumers by imposing tariffs on those products. The question about this element of the agenda is whether or not it will actually increase economic growth or hurt it by making imported goods less attractive for American consumers to buy. Please take a look at this chart to the right where I've illustrated the performance of the S&P 500 over the last several months. I've drawn a blue trend line to indicate the strong rally in the market right after the election through the inauguration. And as we can see, the market continued to move higher from there until about early March. I've drawn another trend line, though, that shows the weakening of the market's rally over this period of time through early April. And a lot of investors have begun to question if the Trump bump rally has now come to an end, particularly because of the failure for the healthcare bill that was proposed on March 24th. In fact, President Trump's approval rating as of his 100th day in office stood at only 42%, marking the lowest rating for any president in history since this period of time has begun to be tracked. Fortunately, though, over the last several weeks, it appears that investor focus has shifted away from the healthcare bill failure to optimism over the recently announced tax reform bill, the strong earnings that have been announced by U.S. corporations, and an improvement in economic growth for countries around the world. So it looks like the market may now be in a new leg of a bull market, even though the Trump rally may have ended. I want to introduce to you a new tool that we're using starting this quarter to get a better overall graphical sense of the health of the financial market environment and investment landscape, known as the Legacy Wealth Partners Macroeconomic Dashboard. As I go through the remainder of this presentation, I'll be referring to each one of these dials along the way that'll help you get a better sense of the overall dynamics in the markets today. The first dial that we'll review on our macroeconomic dashboard is U.S. economic growth. During the first quarter, it came in at a very disappointing 0.7% rate of GDP growth. That was a sharp drop from the 2.1% growth rate that was achieved in the fourth quarter of 2016, and actually the worst quarterly growth rate since the first quarter of 2014. Consumer spending was actually the weakest component of GDP growth overall. That was surprising because consumer confidence has actually been quite strong. Now, President Trump's agenda has focused on improving economic growth to a rate of over 3% a year under his leadership. That remains to be seen given the weak start so far. Milton Friedman, the economist, once said, one of the great mistakes is to judge policies and programs by their intentions rather than the results. Of course, the jury is still out here. It's very early on for President Trump. But because of the weak start for this year, we give economic growth a cautionary rating on our dashboard. On the other hand, the corporate earnings front looks quite strong, actually. As of April 28th, 58% of the companies that make up the S&P 500 index have recorded earnings for the first quarter, and 77% of those companies have beaten their earnings per share estimates. The first quarter growth rate is 12.5% improvement over the previous year, making this the first time the index has seen double-digit earnings growth since the first quarter of 2011. Of all of these sectors, the energy sector has reported the highest revenue growth so far, and the only sector to report a drop in earnings was the telecom services sector. For all of 2017, analysts are projecting earnings growth of over 10%, which is very strong, giving us a strong positive rating on our dashboard for corporate earnings. Next, we'll take a look at interest rates. The Federal Open Market Committee announced at its March meeting that it would raise the target for the federal funds rate by 0.25% again, bringing it up to 0.75 to 1%. The Fed's reasoning behind the increase was the continuing strength in the employment market, a solidification of the financial market, and an uptick in the rate of inflation. This is the second increase we've seen in the last 3 months, with the last one taking place in December. The question is, where are rates going to go from here? On this chart, you can see to the right the expectations illustrated by the Federal Open Market Committee, designated in blue, but also the indications of the Fed Fund futures market, which is investors' expectations for increases in interest rates, designated in brown. The futures market points to an expectation of another increase to take place this June and the possibility of one more increase later this year. So what we can note for sure is that rates are rising, slowly but surely. And because interest rates are growing at a very measured pace, we give this a very strong positive indicator on our macroeconomic dashboard. Now, even though the Fed has raised rates twice since December, the 10-year Treasury bond yield has actually pulled back over the last several months, as you can see by this chart here on the right. In fact, from the month of March through April, yields dropped from 2.6% to just around 2.3%. This reflects an increase in investor concern over rising geopolitical risk, especially because of the tensions developing with Korea. Over this period of time, we've also seen a pullback in mortgage rates, creating a great opportunity for would-be homebuyers, as well as those of you that are still interested in trying to refinance your home mortgage. Next, let's take a look at inflation. According to the Consumer Price Index, it's increased at 2.4% from a year ago, pulling back slightly over the previous month. Now, the Fed uses a different measurement for inflation known as the PCE index, and according to that gauge, we're still below their long-term target of 2%. But as wages continue to grow higher, we're approaching that target. Now, at this point, while inflation is increasing, it's still benign, and because of that, we view this as a positive trend, giving it a strong indicator on our macroeconomic dashboard. As far as unemployment is concerned, we continue to see strength in the employment market. However, in the month of March, we added only 98,000 new jobs, which was quite a disappointment. However, the unemployment rate dropped to 4.5% that month, bringing it to the lowest level that we've seen since May of 2007. In fact, I will note that in the month of April, we added another 200,000 plus new jobs, bringing that rate down to 4.4%. Also, you can see from the chart on the right, the blue line, which shows the trend in the growth of wages. And you can see from about 2012, that trend has been moving in the right direction. As wages continue to move higher, people that were previously discouraged and not looking for jobs are now actually out in the job market, which is a very positive indication. As a result of this trend, we see in the employment market as a very good sign and also gets a positive rating on our dashboard. As I already mentioned, consumer sentiment has also been quite strong. The April reading was slightly below expectations, but the January reading of 98.5 was the highest reading since January of 2004, so we're definitely moving in the right direction. Consumers continue to be very optimistic, but for some reason are holding on to their wallets. The possible reasons that have been noted for this weakness in consumer spending in the first quarter were the fact that around the country this winter was quite a bit milder, so maybe people were not out spending as much money buying stuff that they normally would in typical winters. As well, the fact is that the IRS has been delayed in processing tax refunds for a lot of Americans, so people may have been holding off buying a lot of big ticket items. Now, one factor on our dashboard that we're actually quite concerned about is the valuation levels of the U.S. stock market. This chart here shows the S&P 500 index price to earnings ratio, which currently stands at 17.6, making this valuation above the 5-year average of 15.1 and also the 10-year average of 14. At the current valuation levels, U.S. stocks are not fairly priced, but actually expensive by historical comparisons. Now, according to another valuation method known as the Shiller CAPE, or cyclically adjusted price to earnings ratio, stocks today stand at the third most expensive level in history, being surpassed only back in 2000 and 1929, as we know, both before major market crashes. This method was developed by Professor Robert Shiller, a Yale professor and economist who also was a Nobel Prize winner. Now, according to Shiller, even though U.S. stocks today are high, stocks were at the same level back in 1998, and the CAPE continued to go higher from 2 years beyond that. So just because we're at this current level doesn't necessarily mean that stocks are ready to crash. However, Shiller advises diversifying our portfolios away from the US to actually get exposure away from these valuations to cheaper valuations to be had around the world. Another important dial that we want to take a look at on our dashboard is the trend in the stock market. At today's levels, the US stock market is at near or all-time highs across all the major indices. The trend is very strong and the market continues to shrug off every facet bringing concern into the market. Right now, the NASDAQ composite is just above the 6,000 level. The Dow Jones is just below 21,000. And the S&P 500 is brushing right up against the psychologically important 2,400 level. So for right now, the trend remains our friend. This is a very positive indicator for us. When we look back over the past year, according to this chart of the S&P 500 index, we can see major movements in the market. As we already talked about the first two, but you can also see here the improvement in the market's trend from right after the first round of the French presidential election on April 23rd. This is because of the confidence that came into play as a result of Emmanuel Macron's round in the first round of the election, which would indicate that if he wins as the more moderate candidate, it would signal France's staying in the European Union and a continuation of the EU. Now, while high valuations are definitely a concern for us, the real focus that we're concerned about is the potential for the next recession. Because on this chart, we trace the history of bear markets and the factors that cause those bear markets. We've actually had 10 bear markets since 1929. And out of those 10, 8 of those bear markets coincided with a recession. So the reality is that high valuations alone typically do not bring about the end of a bull market. So to sum it up, it's not high valuations alone that kill bull markets. Bull markets die on recessions. So how does the recession risk look right now? And for a recession risk perspective, we turn to some great research from our friends at Ned Davis Research, who've been tracking this recession probability model that they created since 1979. As you can see on this chart, there are 5 periods indicated by gray bars. Those represent actual recessions over this period of time. The blue line zigzagging up and down is Ned Davis's indicator that tracks recession risk. So they have been right in predicting all 5 of those recessions. Right now on this scale, the level of recession risk is very low according to their probability indicators, which is very good. And what about growth outside the US? Well, on this chart, we take a look at Purchasing Manager Index readings, which also tracks the level of expansion or contraction. The key level on this chart is the horizontal line of 50. If you're above 50, the economy is in expansion. If it's below 50, it's contracting. Right now, 90% of the world economies are actually in expansion, which is a very positive sign for global economic growth. According to forecasts by the analysts and economists at Ned Davis Research, global growth this year is predicted to be about 3.4%, up from 3% in 2016. However, risks do exist, and they include the impact of the Brexit implementation, the French election, which actually now fortunately is behind us, China's rising debt, and continuing tensions developing in the geopolitical environment. The long-term trends, though, in the developed world, such as the US, Japan, and Europe, remain subdued because of slowing growth in the labor force as well as productivity. But the weakening US dollar actually favors foreign investments. Because of that, global economic growth is a very positive indicator for us on our dashboard. As I said, one of the problematic factors for economic growth in the developed world is the trend in weakness in the labor force as well as in productivity. These are both the 2 key drivers of GDP growth. The problem that we're having here in the US is that the working age population is not growing fast enough, and we're having to import more foreign labor to fill the highly skilled jobs that are actually being created in our economy today. The other problem that we're experiencing is that our companies are raising productivity at a declining rate compared to how they were growing over previous decades. So when productivity is growing at a slower rate and we're not adding enough people to the labor force, the economy cannot grow at a very robust pace. Now let's take a look at the overall world stock market. On the right side of this page, we see the world index illustrated by its components. The US represents about 53%. But what's interesting is that most US investors are very underweighted in their portfolios to those countries outside of the US. We can also take a look at the performance of the major market indices outside of the US on the chart over to the left. And as you can see, the emerging markets index for the first quarter gained 11.5%. Asia was also very high overall, And Europe as well is outperforming the US, which is kind of surprising to a lot of people given the recent economic weakness in that part of the world. I think probably the most important thing for investors to focus on is where we are heading to and not where we're coming from. And that's really important when it comes to considering the opportunities of investing outside of the US. One of the most significant factors is the valuation levels are far more attractive outside the US than they are here. And you can see that illustrated by the chart here on the right. Each one of these gray bars represents the 25-year range of valuations for each of these regions of the world. The purple line represents the 25-year average, and the blue dot represents where each of these regions are priced right now relative to their 25-year history. So we can see the US is above average, but we can also see that Japan and emerging markets are quite a bit below average, and Europe is kind of right on par with its own average. As well as the opportunity for increased growth in the European region, all of those factors make investing outside the US very attractive right now. As I've already mentioned, one of the factors that we are quite concerned about is the rising level of geopolitical tension around the world and the risk that that brings with it. Of course, tensions with North Korea are at an extreme. We had the recent attack on Syria. Russia is still supporting Syria. We've had this trend towards protectionism relative to trading partners. And we've noticed a global rise in nationalism, not only here in the US, but in France and in Germany and many countries around the world. It trends towards a lot of people in the population wanting to protect themselves from the impact of immigrants and refugees. And that has definitely had a lot of influence on the elections in these countries over the last couple of years. The French election was also a recent issue that we were very concerned about, but now no longer an issue because of the recent outcome with Emmanuel Macron coming up as the winner. That was a definite solidification of France's position in the EU for now, and a big improvement in the overall global story for European growth. So I've now reviewed each of these indicators on our macroeconomic dashboard, and we can put it all together to see what the overall picture looks like. Putting it all together, here's what we see. The opportunities first. Domestic stocks are expensive, but that alone may not stop the bull market from running further from here. The strong corporate earnings that we're seeing are a catalyst that could continue to lift stocks higher. Rising levels of global growth combined with a weakening value for the US dollar is a perfect storm because as the dollar weakens, our goods and services become cheaper and it becomes more profitable for US investors to be investing outside of the US with a weakening dollar. The valuations for equities outside the US are also much cheaper, particularly in Europe and the emerging markets, and so because of that, investors need to shift their diversification away from US-centric allocations. The risks, though, are the fact that the first quarter economic growth was weak here in the US. If we see a failure of the Trump proposed tax reform, that will be a big stumbling block for financial markets. And finally, it goes without saying that if we have military conflict or war, that will be definitely an issue for the markets to contend with. But for right now, overall, our dashboard looks quite positive today. And we feel optimistic about the rest of this year because of what we see. The weight of the evidence tells us that this environment overall is still good. And I'm reminded of some keys to successful investing that I want to share with you. First of all, you don't want to buy into headlines because the news clouds rational thinking. When everybody's pessimistic, you want to buy and you want to sell when investors are euphoric. You want to diversify across not only multiple asset classes, but global markets. And you want to try to see the forest beyond the trees that lies right in front of you. As we look beyond the trees right in front of us into the forest of opportunity, I want to call your attention to the many opportunities for investors that exist in the coming decades. The first one is the millennial wave, the largest global population trend ever in history. This represents those people born from 1980 to 2000, totaling about 92 million people, exceeding significantly the baby boomer generation. The way that these young people are consuming and making choices today about where they live, how they work, how they raise their families is going to have a significant impact on our economic growth going forward. Over the next 20 years, we also have the potential to wipe out many life-threatening diseases, including cancer, as a result of significant advances that are being made in medical device technology and biotechnology companies. We also have the potential to virtually eradicate global poverty and hunger because of advancements being made in water treatment, also agricultural growing processes, seeding. These things could be very huge opportunities for investors to take advantage of. Also, autonomous cars. Now today, this is very fringe technology. But within just a few years, autonomous cars will be everywhere. Think about the impact on the global traffic grid system if people do not have to be driving their own cars. the frequency of traffic accidents that will see a decrease, the impact on the auto insurance industry as a result of having less accidents. So many things are going to be changing because of autonomous car driving. There's a lot of debate going on about the importance of domestic energy resources and becoming independent from the Middle East, but the reality is within just a few short years, fossil fuels are going to become completely irrelevant, being replaced by nearly free solar energy and other resources that are much more efficient than fossil fuels. Population growth is another very important trend. Today we have about 7.5 billion people in the world, but by 2050 we'll have about 9 billion people. And the areas of growth that will be the strongest are not the US or Europe or Japan, but emerging market economies of the world such as India and the African continent. Those countries or regions will dominate economic growth in the future, even though they have been third world economies in the past. And the most valuable resource in the world will become water, becoming more and more meaningful for pure, clean drinking water for people to have access to. These opportunities are going to be very plentiful for investors to take advantage of, and things that we need to keep our eyes on as we focus on where we go from here. In our last couple minutes together, I want to share with you a review of the Legacy Wealth Partners investment process. Rather than making decisions based on gut feelings or hunches, our investment process is designed around a belief that better quality, long-term results can be achieved by following a consistently repeatable methodology driven by robust quantitative data. This focuses on the collection of important fundamental inputs such as macroeconomic indicators like I showed you, monetary policy, economic growth, inflation, interest rates, investor sentiment, as well as the market trend or technical inputs. Those factors all combined together become the basis of our investment decisions, what we refer to as the weight of the evidence. Our investment process at Legacy Wealth Partners ultimately culminates in the implementation of a series of investment strategies, each designed with its own particular focus and approach, but all very disciplined in the implementation, as well as a keen focus on actively managing risk in the portfolios, and also a focus towards cost minimization for our clients. These become the building blocks in our client portfolios, with each one of our clients' overall portfolio being curated for them and designed for their own individual needs, using these as key components but tailored for their own specifications. But everything that we do, all the investment management and all the planning that we do for our clients really only matters because of why we do it. And that is the mission that drives us every day. It's to empower our clients to live the lifestyle that they envision with a greater degree of financial confidence and less worry. You tell us what your dreams and wishes are, and our job is to do all the heavy lifting to help make those things a reality for you. That's why we do what we do. I want to thank you for taking the time to be with me today. If you have any questions or want to have us address anything in your own personal financial situation, please feel free to reach out to us. Again, this is Brad Levin, CEO of Legacy Wealth Partners, thanking you for joining us.